So, hello friends. Today I am going to start the topic how to prepare cash flow statement. So please pay very good attention here, dear children. There are three activities. First activity is cash flow from operating activity. So what comes in operating activity? In operating activity, only regular activities of business are recorded. The activities which are main activities, that comes in operating activity. In short, I am telling you the regular activity of the business are recorded in the activity is known as operating activity. All current assets and current liabilities with some exceptions are recorded here. Yes, children. So there are some stages. We will learn step by step how to prepare cash flow statement. So pay very good attention, children. We start with surplus. We take the differences of current year and previous year. Children, this is the net profit. And then we add if there is any transfer to reserves. And then if any proposed dividend of previous year is paid during the year, then only it is added, children. Remember, if it is paid during the year, then only proposed dividend of previous year is added here. And then if there is any interim dividend which is paid during the year. Interim dividend means, children, the dividend which is declared before annual general meeting. That is known as interim dividend. If it is paid during the year, it is also added. Then provision for tax for the current year is added here. These are appropriations, my dear children. And after all, extraordinary expenses. The meaning of extraordinary expenses is the expenses which are not ordinary in nature. Normally, the expenses which we do not plan in the business, which we do not imagine in near future also. If we plan for any expense, that is, we make provision for that. We make arrangement for that. But there are some expenses for which we do not plan. हमने कभी plan ही नहीं किया है कुछ expenses के लिए. There is no plan for it. Like in any business, no businessman plan for any natural disaster, loss by earthquake, loss by natural disaster, loss by tsunami. Nobody has planned for any loss by any natural disaster. So these type of expenses are known as extraordinary expenses. And children, extraordinary expenses are added here. Remember, it is added here and then subtracted at the end. This is the most important point you need to remember. And like extraordinary expenses are there in the business, there can be extraordinary income for which there is no planning, no plan, and business is not working for that. Some examples like compensation received from the government, an insurance company, refund of tax. These are some few examples of extraordinary incomes. If there is any extraordinary income, it is subtracted here and added back at the end of this operating activity. Children, this is the first stage, net profit before tax and extraordinary item. This is the first stage. You need to first calculate net profit before tax and extraordinary item. The beginning is more important. If beginning is clear, if beginning you understand, then cash flow statement you can easily solve. So under cash flow from operating activity, remember children, this is the first step, first stage. Now in this net profit before tax and extraordinary item, we adjust some point. Like we add non-cash expenses. As its name is suggesting, non-cash expense, the expense for which cash is not paid. There are only two types of expenses for which cash is not paid. One is depreciation and second is amortization. Then we add non-operating expenses. Non-operating expenses are those expenses, my dear children, which are not operating, which are not part of the regular activity of the business. Like electricity expenses is the regular expenses. Like salary paid is the regular expenses. Which are non-operating expenses. Which are non-operating? You can see here, dear children, like interest on bank overdraft is not regular in nature. It is regular up to the loan is not repaid. Interest on borrowing on debenture is non-operating. It is not directly related with the business. Like writing of underwriting commission, share issue expenses. These expenses are paid only when share is issued, when capital is raised. Loss on sale of fixed assets. Do you think, children, that loss on sale of fixed asset is a regular expense? It is not regular. So these are non-operating expenses. These type of expenses are added back. And in the same manner, non-operating incomes are subtracted. Any income which is not the regular income of the business is subtracted here. Like interest received. Interest received by investment other than business, trade investment. If this type of interest is received, then it is non-operating income. Dividend received is business if the company has invested their share in any other company and then dividend is received, then it is other income. That is non-operating income. Rent received, if it is not regular in nature, then it is non-operating income. If we are not earning from the regular income of the business, the main activity of the business, then it is rent received is the other income. That is non-operating income. Gain on sale of fixed assets. It is not regular income. It is not the income of the main activity. That's why it is non-operating income. So all these incomes are subtracted, and when we adjust all these points, we get operating profit before working capital changes. My dear children, this is the second step. This is the second stage where you need to reach. When you reach on this stage, your half of the work is done. Very simple. And then you need to adjust a few more points. Like you need to add decrease in current assets if there is any, and increase in current liabilities. So examples I have put here, like decrease in inventories, trade receivables, accrued incomes, prepaid expenses. These are current assets. If there is any decrease, it means cash is increased, so it will be added. And increase in liabilities, current liabilities like trade payables, outstanding expenses, advance income. If there is any increase in current liabilities, it will be added. Again, if there is any increase in current assets and any decrease in current liabilities, children, it will be subtracted. Some examples, like there is increase in inventories, trade receivable, accrued incomes, prepaid expenses. If there is any increase, it will be subtracted because cash reduces. Whenever cash increases, we add. Whenever cash reduces, we subtract. This is what the principle of cash flow. Cash flow, inflow, outflow. Cash comes in is inflow. Cash goes out is out. Whatever be the reason, when cash comes in the business, we add. Whatever be the reason, if cash goes out from the business, we subtract. Simple principle, simple rule. Like here, decrease in trade payable, outstanding expenses, advance incomes. These are current liabilities. If current liability decreases, it means cash goes out. We subtract. What we get? Cash generated from operations. This is the third stage, children. You need to reach up to this stage. And finally, whatever you get, you need to subtract income tax paid. Okay, and then extraordinary incomes which were subtracted earlier, now it is to be added back to remove the effect, and extraordinary expenses which were added earlier, now it is to be subtracted to remove the effect. Children, you will get cash flow from operating activities. That's it. It's very simple. You need to simply follow these points which I have given. You can solve any question of cash flow statement. It is for true. Now let us move on the second stage, second activity, that is cash flow from investing activities. Children, in general, in simple, non-current assets and non-current investments are added in this activity and subtracted. Non-current assets and non-current investments are used to write in this activity. Okay, so let us see. Like proceed from sale of fixed assets. When we sell fixed assets, cash comes in, we add, it is added. Proceed from sale of investment, it is non-current investment, children. Okay, so it is added. When we sell investment, we get money. Proceeds from sale of intangible assets, again it will be added because cash comes in. Interest and dividend received, it is income for non-financial company. Okay, if it would be financial company, then it will be the part of operating activity. If it is non-financial company, then interest and dividend received is not the main income. That's why it will be recorded in investing activity. And rent received. is the part of investing activity because it is not the main income of non-financial company. Purchase of fixed assets, subtracted, because when we purchase, cash goes out. Then purchase of non-current investment, when we purchase, cash goes out, that's why it is subtracted. Purchase of intangible asset, any intangible asset, if purchased, cash goes out, it will be subtracted. And this is how, children, it is very simple to calculate cash flow from investing activity. If it is plus, then it will be cash flow. If it is negative value, then it will be cash used in investing activity. It is so simple to prepare. Only non-current assets and non-current investment are added, children. Simple. Now let us see the third activity, that is cash flow from financing activity. Now I am again giving a small trick to prepare cash flow from financing activity. Shareholder fund and non-current liability of the balance sheet comes here. Remember, if you want to note, you can note. Shareholder fund and non-current liability will become here. If cash increases, we add. If cash decreases, we subtract. Simple principle. Let us see. Proceeds from issue of shares and debentures. When we issue shares and debenture, what happened? Cash increases, we add. Proceeds from long-term borrowing. When we take loan, what happened? Cash increases, it is added. You can see. Increase in bank overdraft is added. It increases. So that's why it is added. And then payment of final dividend is subtracted. Payment of interim dividend is subtracted, cash goes out from the business. Payment of interest on debenture and loan, subtracted, cash goes out from the business. Repayment of loan, repayment of debenture, preference shares, payment of share issue expense or underwriting commission, children, cash goes out from the business. That's why these points are subtracted. And finally, we get cash flow from financing activities. If it is positive value, if it is negative value, it is cash used in financing activity. And when we add all these three values, cash flow from operating, investing and financing, dear children, what we get? Net increase or decrease in cash and cash equivalent. And when we add all these three, if it is positive value, then it will be net increase. If it is negative value, then it will be net decrease in cash and cash equivalent. And then finally, when we add cash and cash equivalent in the beginning of the year, cash and cash equivalent here means it comprises cash in hand, cash at bank, short-term deposits, current investments, marketable securities. When we add cash and cash equivalents in the beginning of the year, what we get? We get the final answer, cash and cash equivalent at the end of the year. This is what it means. So this is my small effort, small attempt to explain cash flow statement in a very simpler manner. I hope all these points are very clear and very simple to all of you. Thank you, my dear children. Thank you for watching.